profitability. Deirdre is here. Deirdre, explain it to us.
Yeah.
Okay, Tyler, let me show you a chart first. I'm going to show you Uber versus Lyft versus Instacart, and you can see that over the last year, Uber has just separated itself from the pack because it has achieved sustainable profitability, and I'm talking net income, not adjusted EBITDA, and a large part of that is efficiency in its main business, and Dara Khosrowshahi, the CEO, driving that efficiency, but it's also been a new revenue stream. High margin advertising business has proved quick to grow, and it's more profitable than the other business of ride sharing, which uses real world inputs like drivers and cars. So advertising has really proved the key for gig economy companies. Instacart has been looking at it for ages, but Uber has really made it happen quickly. It's projecting a run rate of $900 million for the next 12 months. Instacart is expected to post $243 million in advertising and other revenues this quarter. Lyft is just getting started here, but there is that promise that these companies can actually become profitable and sustainably so because of other revenue streams like advertising. But Tyler, this is against a different backdrop. What's also happening tomorrow on Valentine's Day is a strike from drivers of Lyft, Uber, and DoorDash, and that's the other very important side of this equation, is that these regulatory battles and these regulatory threats that could upend the entire business model are always present, and that's something for investors to keep in mind.
You know, I think of Google, which is sort of a similar model in a way. Google is now a huge advertising company, right? I mean, that's where they make their money. And so these companies seem to be taking a page from the Google book.
I mean, Google's search ads have been called the greatest business model of all time. And, you know, even in recent days, and sometimes people point to that as the reason why they won't totally disrupt themselves in the age of generative AI. It's just too lucrative. And advertising is really this sort of pure tech business, right? When we talk about
closing
Uber,
in on a
Lyft,
double
Instacart,
bottom now.
And DoorDash, it's unclear whether they
Closing in on a double bottom on the SPX. It's going to start looking interesting. How would I do this here? First, I want to clean it up. No, we wait. Just straight across low support. Right there. That's $2 down. The next one's right about, oh hell, we're about there. 4772. Okay. We just hit my first support right here. I don't know if I've said this a couple of times, probably have. We broke support. This is bottom line. Right now, ooh, problem. Big problem. Been waiting all day for this. $49.60s. Bye-bye.
got debt, it's not profitable. But again, if you're in it and you participate, if they do catch a spark and they get a squeeze, I think you sell those shares into the squeeze. We're not interested in this name until we see a real fundamental turnaround here.
What do you think of the market today? Now 603 on the Dow right now, quickly.
Woo!
Yeah, it's a little wake-up call. I mean, we've gotten very, very stretched, and, you know, the market tends to take the stairs up and the elevators down. I would say that if you've been on the sidelines and waiting for an opportunity, I think this is going to be a good one. It could last a little while as we digest the CPI data, but it's to be expected. We've run a very long way for a long time. Pullbacks are welcome here.
All right, Quint, thank you very much. Good to see you, my friend.
You too.
You bet. Quint Tatro of Jewel Financial. And that, folks, does it for the exchange on this bumpy day for the Dow, now down 599. Coming up on Power Lunch, the NASDAQ under pressure as well today. But Loop Capital says to believe the earnings hype in some tech names. Believe the hype. We've got the stocks, they're getting more constructive. Getting ready to join me here on set. We'll be back with you on the other side of this quick break. See you.
Yeah. Boom. Now all of a sudden they're talking about a pullback. Kind of want to take this trade, but then I don't. PLTR came back. Tesla come back to support, flagging out. Then you had the IWM. We've got a shoulder line here. Oh, SPX is up a little bit. Better watch this. Just in case. $49.60. What time is it? 1 o'clock. Jimmy, wait. Though she right now 165 if I buy one. $150. Sucker. Might be 2 strikes against me now. I'm crazy. Huh.
cycle, but it doesn't make the middle class feel very happy. As to Tyler's view of rates, wow, look at an intraday of 2-year. Big pop. Now, 2-year notes right now are on pace for
Market's
not only
not
the
happy.
highest yield close of the year, the highest yield close for 2 months. And 10-year, highest yield close since the end of November, 2.5 months. In the grand scheme of things, interest rates continue to look firm, but don't dispense the notion that today's report doesn't have some good news, because when the rate of change goes flat, it most likely could be a green light for the beginning at some point nearby of the easing cycle. Courtney, Tyler, back to you.
Whoa.
Stuff, Rick. Thank you very much. The Dow
Steve.
tracking for its worst day in nearly a year following that hotter than expected CPI number. So here with more on the sell-off is Mona Mahajan, Principal and Senior Investment Strategist at Edward Jones. And I guess we'll just start out, Mona, if you think that this sell-off is an appropriate reaction to the data. I think Rick and others bring up a very interesting point about January being a reset month for prices.
Yeah, absolutely. And look, I think others have brought up this point as well, but we moved almost 22% higher in a straight line in the S&P 500 since October 27th of 2023. So were we due for a bit of a pullback, a correction, at least a period of consolidation? The answer there is probably yes. And was this CPI report a catalyst to get us there? Perhaps. And look, there was some disappointing data in the CPI. We saw shelter and rent components higher than
Jimmy gets an F for today.
Headline inflation, which we thought we'd get a 2 handle on, finally come in at 3.1%. But when we look broadly, the trend in inflation is still moving in the right direction. We were at 3.4% on headline last month. We're at 3.1% this month. Core inflation remains flat at 3.9%, but we think there are signals that could get us to a more moderating trend even there. And specifically, we think the real-time data in shelter and rent pricing is moving in the right direction, and that'll show up with a lag in the months ahead. So more broadly speaking, we do think that we could be due for a correction, but we don't yet see any tenets in place for a correction to become more nefarious, a bear market of any sorts, because we do see better inflation trends. We do see a Fed pivoting later this year. And by the way, we see an economy that's holding up pretty well.
And to your point there on the Fed, when the Fed looks at this, are they also going to look at the trend and say, well, look, we're going in the right direction, even if some of these components were a little hotter than expected, particularly that shelter and rent? Or does this push out potentially their decision to cut interest rates a meeting or so beyond maybe where they would have before this data came out?
Yeah, look, the Fed has already told us that they want to be patient here, and they've earned that right. The economy was going in the right direction, and inflation was moving lower even as we got this better economic growth. So they can certainly be patient here, wait, we think, until probably the June meeting. And we think now the market is pricing in somewhat of a more reasonable and better aligned number of rate cuts with what the Fed is expecting as well. So the market, as of this morning, looking at 4 rate cuts beginning in June. We're in the same camp, 3 to 4 rate cuts probably beginning in that June timeframe. You know, keep in mind, if the Fed were to do more than that, 5, 6 plus, it's probably because the economy has faltered in some way. And if they're going less than that, 0, 1, or 2, it's probably because inflation is continuing to remain sticky and the economy is also above expectations in a more meaningful way. And so we think there's a sweet spot that's emerging, that's 3 to 4 rate cuts, that gets the Fed gradually back towards a more normalized level of interest rates. And so we think what happened this morning is actually probably a healthy adjustment.
We're looking at the Dow now down 660 some odd points. I guess that would be the session low. I'm wondering, the idea of rate cuts is anything but off the table now. It just looks like the trajectory may be longer to begin, maybe a little shallower, not as steep a decline, maybe not as many. But so long as the stock market is anticipating interest rate cuts, there's really no impediment, is there, for it to continue to move higher? In other words, it's not as though the Fed or anybody is saying, hey, rate cuts are done. It's just a question of that anticipation.
Irrational exuberance.
Yeah, I think that's well said, Tyler. And look, I think when we think about what could create or drive a bear market, you know, usually it's if you're in a recession or entering a recession. It's also if the Fed is raising rates. And thirdly, you know, you have your unknown geopolitical risks or an external shock that could cause disruption to the system. Neither of those three are in place today. So which makes us I kind of feel like if we are headed towards a period of volatility, a correction, that's really the opportunity, especially for those market participants that really didn't get involved late last year when we got that very rapid rise in the S&P 500. So we would take advantage of periods of volatility, position yourself for that potential for that Fed rate cutting cycle that we see emerging in the back half of this year.
All right, thanks, Mona. Good to see you. Mona Mahajan of Edward Jones. Appreciate it. The Dow down 660 right now, 1.7%. The S&P yielding the 5,000 mark at 49.38. And the NASDAQ, the biggest loser there, down 2% at 15,623. Big tech getting hit hard. The NASDAQ is, as I mentioned, down 2%. The software and services ETF, the XSW, down more than 2.5%. After the break, we'll speak to an analyst who's raising his price targets on a couple of key tech names. There you see them. Plus, consumer stocks in focus. Coke and Molson Coors raising prices, their earnings better than expected. But recently, consumer stocks have been reporting lackluster sales. We'll break down all of this when Power Lunch returns.
SMCI. Big bubble on that baby. A big bubble.
Washboardjim.com.
Dow at session lows down 672 points. Welcome back to Power Lunch. Market losses are accelerating there. The NASDAQ too down nearly 2% today after a hotter than expected CPI report this morning. And among those laggards are mega cap tech, Meta, Amazon, and Alphabet. But my next guest recently upped his price targets on all three of those names, especially Meta, hiking his target from $470 to $555, citing upside momentum driven by AI. Joining us now is Rob Sanderson. He's senior internet analyst at Loop Capital Markets. Rob, thanks so much for joining us. I guess let's start there with Meta, since that was kind of a big price target hike. And I guess maybe today notwithstanding, explain some of your reasoning there for why you see the upside potential in Meta.
Yeah, there's a lot of momentum. Obviously, surprise on the upside, very strong fourth quarter, but the outlook was really what caught people off guard and really unexpected. Revenue growth expected to accelerate by around 400 basis points to 29% at the high end, which is obviously very impressive on numbers that are so large, and a comparison that gets 700 basis points tougher. An acceleration on that kind of comp at this kind of scale is just kind of unheard of. It shows a lot of momentum behind the businesses. I think they've found a lot of unlocks in applying artificial intelligence to make advertising easier. Like that's, I think, the underlying story behind all that momentum. And yeah, there's a lot to like at Meta.
Before we move on to some of your other names, I mean, I know AI is sort of the buzzword across all tech companies and really, I guess, almost all companies in general these days. But is there a risk as we go into this very potentially contentious election cycle of AI being used for not so good across social media platforms like Meta?
Yeah, and this company certainly has history on such issues. So it is definitely going to be a growing focus through the year. The company has invested, a lot of time and attention and resources and frankly money in just, keeping bad actors off the site. That's always a cat and mouse game. There's always going to be, potential for, ill intent on such a wide scale and influential platform, especially into an election cycle. So be assured, it's not going to come as a surprise. They're preparing for such interference, and we'll see how they manage through this.
What's working best for Meta?
I think it's the ability for them to make it easier for the long tail of advertisers. It's small and medium businesses that are really what make Meta the envy of the industry. They stopped disclosing this metric 3 years ago when they hit 10 million, and we should definitely assume that it continues to grow. There's a lot of a focus on how the AI platforms are doing a better job of targeting for large advertisers. But it appears to me that Meta has really sort of cracked the code and is now unlocking a lot of value for the smaller mom and pops. And they are comparing against a pretty disruptive period where the changes on the Apple platform I think really took a lot of time for those smaller advertisers to adjust.
Rob, I want to move on to Google. I understand you have this as a whole, but you up the price target here from $140 to $155. Interesting though, Google ads were up just 11% in the fourth quarter, while Meta grew their advertising revenues by 24%. So certainly not seeing at least as much momentum as Meta here. We have the Dow down, just to alert viewers, down 700 points now. That's good for 1.8%. But again, Rob, back to Google here. I mean, what do you like here that you see upward momentum getting us closer to 155 when maybe it does not have the same types of momentum in an area like advertising as Meta?
Yeah, I mean, the Google businesses are performing well, and management's very focused on cost discipline. I think the issue that maybe holds it back compared to some of its mega cap peers is that Google's seeing more competitive pressure now than we've seen for a very long time. And in the ad business, it's the growth in social and the big numbers that Meta's putting up. Retail media is becoming more of a competitive threat, especially Amazon. But really, the market's very focused on AI, and particularly generative AI, as you mentioned earlier. And it's not clear that Google is going to be able to maintain their dominance. Like it has been the best technology company for a couple decades, and now they're not leading the way. We just saw reports last night that OpenAI reached a $2 billion revenue run rate in the fourth quarter, the fastest company in history to do that. Google's been investing more in AI than anybody for forever, and here they are with a startup, stealing the show. So that's going to just, I think, raise this wall of worry for investors and probably hold the stock back.
All right, Rob, thank you very much. Rob Sanderson, we appreciate your time today.
All right, thank you.
All right, let's talk about NVIDIA, because we haven't mentioned in the last few minutes. It's turned lower after spending most of the morning in the green, following some positive analyst commentary. But even this AI darling is not bulletproof. Christina Partsinevelos looking at the challenges it's facing, and it's got, I think, earnings next week, if I'm recalling correctly, Christina.
Yes, next Wednesday. And you made a joke about, oh, we haven't spoken about NVIDIA in a while. So that's why I decided to take a more contrarian take. This is a company that has surpassed Amazon in market cap yesterday and a bit today, witnessed a remarkable $500 increase in its share price over just a 52-week period. So it seems like this stock is pretty much invisible to bearish sentiments. With no sell notes from analysts in over 9 months, it's easy to overlook potential concerns. But amid this AI euphoria, there are some cautionary flags that emerge. Wolf Research, for example, highlighting easing supply constraints, which may dampen chip demand in the later half of this year into 2025. Morgan Stanley questions the sustainability of NVIDIA's growth trajectory, forecasting a possible plateau in 2025. Barclays credit team, not sell-side credit, predicts a moderation in demand as the industry transitions from training to the inference phase within large language models, which means they need maybe fewer GPUs. There's also heightened competition from industry giants like AMD, Intel, and then also mega cap firms like Meta and Amazon creating their own in-house custom chips. Examples of what could erode
This could go on for a week.
Dominance. And then, of course, you got looming threats of further tariffs to China, especially under a Trump presidency, which would drastically impact NVIDIA's data center sales.
What now?
The Barclays credit team also notes NVIDIA's venture capital arm made about 33 investments between January and October 2023, with the majority of those in Q3. And they suggest that NVIDIA is actually financing startups who use and buy NVIDIA technology, which implies that NVIDIA could be possibly funding its own customers. Again, this comes only from one credit note, but 92% of sell-side analysts say otherwise, saying NVIDIA is still a buy. I saw the highest price target today, what, $850, heading into earnings, which are out next Wednesday.
Yeah, apropos those earnings that come out next Wednesday, here's a stock that is on its tippy toes. And it is often stocks that are on their tippy toes that are vulnerable if there's anything in that earnings report that is in the least bit nitpickable.
You're right, and the options market is implying some type of 8 to 9% move in the stock post earnings, but it seems based off of all these analyst reports and all of their customer checks and inventory checks, it seems like the backlog issue is still a concern in the near term, which should help NVIDIA, get that supply. Customers are still racing over each other to try to get these GPUs. So I'm sure NVIDIA will make a comment about that. They're going to comment about their AI event on March 18th, where we'll hear more details about their next iteration of the GPU. So there's a lot of positive factors that could help this stock propel forward, even if they don't have that massive beat that we saw the previous 2 quarters.
Yeah, absolutely. Christina, thanks very much. You'll be following it all for us, I am sure. Christina Partsinevelos. After the break, we will dive into some moves in the energy space. Check out the solar stocks. The TAN ETF down 5%. We'll be right back.
Flash courses.
Welcome back. The Dow is now down 715 points, closing in on 2%. We've slid more than 100 points in just the last half hour or so. Let's zero in, meantime, on energy. The cold weather and snow on the East Coast, yes, the first snow of scale in about 2 years, helping nat gas today. Pippa Stevens joining with a look at at that and all the big movers in energy. Pippa.
So it's actually not helping nat gas.
Sorry.
So we have the snow on the ground outside, but nat gas is down another 4% today and falling to the lowest level since July 2020. Continues to be these 4 key headwinds. That's elevated storage, record production, this really warm temperatures that we've seen apart from today and that one brief spell in January, and then also the outage at one of Freeport's, one of their 3 LNG trains. So that's having an impact because that cuts demand. And so this drop in nat gas now at 169, that is bringing down nat gas stocks. So names like EQT, Coterra, Chesapeake, and Southwestern, all in the red today. And now notably, EQT is the largest nat gas producer in the U.S., and they do report earnings after the bell today, so we'll hear what they say. Moving over to oil, which is actually in the green.
Oil.
The hotter than expected CPI report. So Dennis Kissler over at BOK told me it's several things, including lower Russian exports, as well as technical factors helping with WTI above the moving averages. Now this strength today, though, is not enough to lift energy stocks, which are lower across the board. However, there are a few notable ones bucking the trend. You see there Marathon Petroleum and Phillips 66. Those 2 names are in the green. And then finally, one area that's definitely not shrugging off the inflation report, you see it there, is solar stocks. The TAN down almost 6%. It is those residential installers, Sunrun, Sonova, and SunPower, that are all down more than 10%. They are very sensitive to higher rates. It makes their capital expenses more costly, and then also it makes systems more costly for consumers, which leads to softer demand. So a lot moving in energy broadly today.
And so solar down, and you explained that well, but I still don't quite understand the move in crude oil today and why that's not lower.
Well, crude's been going sideways for a very long time, and so I think that we've seen kind of these oscillations between the current like $78 level. Yep. So I don't think there's so much of a fundamental shift today, but it is above those key moving averages. We did see some slowdown in the Russian export, but not a meaningful move by any means. I did say that one trader said that the next thing that's going to impact prices will be the Fed rate cut, and so we're going to be trading in a range for quite some time, it would appear.
Well, like you said, shrugging off the CPI report, which is bucking the trend of almost every other asset class, it seems today. Thank you very much, Pippa. Well, let's get over to Kate Rogers for a CNBC News Update. Hi, Kate.
Hi, Court. President Biden just called on the House of Representatives to quickly take up the supplemental aid bill, saying opposing it and the Ukraine aid within it is, quote, playing into Putin's hands. He also blasted former President Trump's comments criticizing NATO. NATO will reportedly announce tomorrow that most of its member nations will hit defense spending targets this year. That's according to a report in the Financial Times, which says the alliance will report that 18 of 31 members will hit the target of spending 2% of gross GDP on defense, and that it expects 2/3 of the alliance to eventually hit that goal in 2024. And an iconic site along the Paris skyline visible again after nearly 5 years. The new spire-top Notre Dame Cathedral finally revealed after the 2019 fire that nearly destroyed it. The original spire crumbled as the flames engulfed the cathedral. Back over to you guys.
A wonderful thing to see that go back up. It was a frightening day. Thank you, Kate. All right, we will continue to watch all the market action. As you see there, the Dow down 700 points on the nose, continuing to make new session lows. The NASDAQ off more than 2%. S&P 500 down 1 3/4%. Concerns about the consumer and the Fed weighing on stocks following a CPI report that came in hotter than forecast. That is causing big losses for payment stocks like Affirm, down 11%. More on that in a minute as we head to break. A quick power check. On the positive side,
Well, does it flush out today? Or does it continue? Because Uncle Zimmy is now looking at, I've failed twice on this trade today, the 49.45 or the 49.50. Dang, $2.
But to Quincy's point, a lot of that had to do with some of the hyperinflationary environments where they operate.
Here's the
countries
63.
like Argentina or Turkey, where they're saying outsized pressures. That's also driving a big currency hit as well. And I'll also just say on cores, if you look at the conference call and hear what they had to say, expect net pricing to revert to historical levels.
Oh.
That's what the company says. In the US and Canada, it's
Whoa.
approximately 1 to 2%. So Courtney and Tyler, disinflation is happening in the food and beverage space. It's coming back down to normal levels, but it might not feel that way to ordinary Americans who are shopping, all of us at the grocery store, because they're so much higher than they were several years ago pre-COVID, right?
Let me understand.
Pre-COVID,
Let me understand the
Girl.
hyperinflation part of this. In those countries where it is a problem, like Argentina,
Yes.
the issue there is that the consumer does not have the money to spend on a little luxury like a Coca-Cola.
Well, that and the inflation rates are just sky
They're so high.
they're like 50% inflation rate. So Coca-Cola has to price their items so much higher on the grocery store shelves there. So yes, there's
And that
consumer
becomes a
pressure,
barrier
but
to the consumer to buy it.
absolutely, and it also adds to pricing growth in the top line because Coca-Cola is raising prices to that extent, but it hurts them on the currency impact because the currencies get devalued so much
Right.
that chips away at all that money when Coke has to, because it's an American company, bring it back home.
Talk to us. Oh, sorry, go ahead.
No,
please.
I was just going to say, Sarah, as I think about this, some people are just very loyal to Coke or Pepsi. If that's a drink that they drink fairly regularly, it seems to me like the demand is fairly inelastic. Maybe that's only in countries where we have inflation under control, like the United States. We're not talking about Argentina, I guess. Is that wrong? I mean, do these companies really need to revert back to historical levels, or can they afford to keep pricing where it's gone?
Well, I think that that they tend to track the cost inputs, and if the cost is coming down, then they're not going to. They say, at least, they're not going to dupe consumers to preserve margins and just keep the pricing levels high. You're right, they're consumer staples, but every consumer has a pain threshold. And what we've seen beyond, Coke, really, Coke had higher volume growth, so did Coors, but the theme of the earnings this season for packaged goods and beverage companies, Courtney, has been lower volumes. We've actually seen those volumes go negative. So there is a point in which the consumer says, no more, and it really starts to hurt. So what the companies need to figure out right now is that balance where they are still growing and still getting that pricing, but at the same time getting volumes back up. And I would add another complication is the White House has really made a big political point lately of pointing their finger at food companies, at grocery companies, for keeping margins high at a time where their costs are falling down. Lael Brainerd was on Squawk on the Street with us this morning, the NEC director from the administration, and we talked about the today's CPI report. And food at home inflation did see a jump month over month, but year over year it's come down for about 17 months straight. And she said, look, these food companies need to keep bringing their prices down to match their costs. So they're really being held to account here when it comes to the administration looking for scapegoats on the inflation story.
Yeah, certainly a political focus. Sarah, thank you very much.
Thank you.
Well, Valentine's Day is tomorrow, hint, hint to everyone, and the market for fine jewelry has actually changed dramatically in the last several years. So in 2020, only 2% of engagement ring diamonds sold were lab grown. This is according to Angar's CEO, Ankur Daga. By 2023, though, 50% of engagement ring diamonds were lab grown for 3 years, which are chemically, optically, physically identical and certified real diamonds by the FTC. Lab grown now costs 75 to 90% less than a natural diamond, and natural diamond prices are down 35 to 45% in just the last 18 months. It's opening up the market for diamonds to more consumers.
The jewelry industry worldwide is roughly $330 billion in revenue. I think that actually within a decade gets to $1 trillion, so it triples.
Another trend, Brilliant Earth CEO Beth Gerstein and Signet Jewelers tell me consumers, particularly Gen Z, are leaning more toward colored gemstones to express individuality. And just as demand for gemstones is increasing, wouldn't you know it, the world's supply of natural gemstones is dwindling. So you put that together, gemstone prices are appreciating faster than the S&P 500. Tourmaline prices, for example, are up 36% a year over the last 3 years. Ruby prices are up 17%. Tyler, I know this pain specifically. I've bought both a ruby and a tourmaline ring over the last 3 years because they are my children's birthstones, and I was sort of surprised at the prices, and now I know why.
We had right there. You can't put an S&P 500 on your finger.
You can't.
You cannot
really
do that.
Can't.
Would it matter to you if you found out that Jared gave you a lab-grown diamond as opposed to a natural mined diamond?
I think several years ago it might have, but now that I really understand that lab-grown diamonds are chemically, physically, optically the same as a natural diamond that came from the earth, I don't think it would. I mean, the FTC certified it, and from what I've come to know, the more perfect a natural diamond is, the harder it is for a jeweler to tell them apart under, the special eyeglasses.
Yeah.
They cannot be told apart because they are real, in fact.
Interesting.
Yeah, fascinating.
All right, still ahead. We will get some technical support. Our chartist will tell us which name he's watching for the long haul when Power Lunch returns.
3-day pullback, maybe? Today's Tuesday. Okay, we had a little breakout here. Trying to figure out where support is. Could be right there. No lower than that. That'd be nice if it held there. Jimmy's going to try again. $49.50s. $110. Oh, 5.
CNBC.
Welcome back to Power Lunch. Time now for some technical support. We have 3 stocks making some technical moves that we want to bring into focus for you. Our chartist today is Jay
Technical
Woods,
moves.
Capital Markets Chief Global Strategist. First up, the Russell Small Cap ETF. Jay, you say the relevance of this chart is to show the rally maybe broadening out. Well, maybe not so much today. Russell 2000 down a good bit.
We're hoping that this rallies out. What we've had here is a ridiculously long base, about 18 months. It looked like it was breaking out. It broke out above 200, and then it failed. A lot of people call this what we say a bull trap. And if it was a bull trap, we would have had a fast move back down. We didn't this time. Something changed. It held the 50-day moving average. We're testing it again right now. We are at that threshold. If you're trading this, you're watching 194 very carefully. I'd probably stay away from it. And
191,
buy a little
buddy.
bit more on strength. But 49% of this index are industrials, financials, and healthcare. Those sectors are starting to act stronger, except for the regional banks and the financials. But it looks like it's poised where it's finally going to get out of this chop zone, this hot mess zone, as we like to call it.
Well, it's a
and
good pullback
hold
today.
these moving averages. So any pullback, I think the story's changed. I think we can buy it on weakness. And your risk reward is still 23%.
The moving average is the lavender one.
Yeah, the 50
and what's the
and
other
the
one?
200.
What's the taupe colored one?
The taupe, taupe. I don't know taupe, but
the taupe is this brown or whatever.
That's
gray.
taupe. I'm learning something new every day. That's the 200. It's a mess, 200. Like I said. Okay. What you want to watch is this 200 level, and you want to watch it not make a new low, get out of this chop zone. It's going to take some time, but over the long term, I think we rally and we break out of this zone. We form maybe a zone a little higher.
All right, let's go to
see it
Coin.
drop a little more,
Shares down
buddy.
Today, Coin reports fourth quarter results Thursday. What are we seeing in the technicals on that
Yes,
one?
very important to watch earnings. It has moves of plus or minus 8% on average during earnings. We're watching a little weakness today. The stock had made a tremendous run after breaking this nice base. It ran to about 190, 187 to be exact, and it's pulled back. Where did it pull back? Old resistance became support. So we're watching this.
He says the same thing I do.
I think any pullback on earnings, given that Bitcoin is at 50,000, given that Bitcoin has a little more legitimacy, it's an asset class here to stay. I think Coinbase is
130,
poised
buddy.
to reverse and climb higher. You have good entry points around this 115 to 120 area, and if we can gap up above the 50,
oh, that's a good
I think
spot
we can
too.
run back towards 190, and guess what? Over the long term, it has a lot more to reverse. When they went public at 250. It spiked as high as 387, I believe. I don't think it's going to go that tremendously to the high side, but the risk-reward setup, the entry points are there. You can buy on weakness if it holds 120 to 115, and then on strength, I think it rallies to 190. So you have two possible entry points on a miss or on a hit with this earnings on Thursday.
All right, let's move on to ICE Intercontinental Exchange. What are you watching on this one?
Well, let's talk a little bit about the long term. This is a stock that over the long term is in such a nice place. And what happened? We had two blips. One was COVID. All right, everyone suffered during COVID. And then in 2022,
okay, we've got a double bottom.
bear market, they
SPX.
made a big acquisition, a company called Black Knight in the mortgage space,
quiet.
mortgage technology.
You talk too much. Major support here on the SPX. Didn't hold it.
Breaks out, I think we start another long channel to the upside over the long term.
ICE.
So, ICE.
Not on the rocks.
Yeah.
ICE. All right, Jay, thanks. Courtney.
Good to have Jay here with us in studio. Well, still ahead, innovation is sweeping the agricultural industry, but as some farmers struggle to stay afloat, will demand for these new high-tech tools dwindle? Our own Jane Wells gives us the details next.
57% of black business owners were denied bank loans at least once when starting their business. That's compared to 37% of non-black owners. Despite this, many African-American entrepreneurs report feeling optimistic about their futures. Celebrating Black heritage, I'm Sharon Epperson.
Nine more minutes to power hour. I call it irrational exuberance. Big flush.
Said.com.
back to Power Lunch, everybody.
Big
Farm
flush.
equipment now more innovative than ever, but manufacturers will have to really stretch their
We're
creativity.
almost to the 21 in one day.
Buyers. Our own Jane Wells joins us live from the World Ag Expo in Tulare, California. Did I pronounce that right, Jane? I think I blew it. Jane Wells.
It's Tulare. You're very close, Tyler. Thank you. Yeah, about 100,000 people are expected out here. Now, look, this is a baler and a tractor from New Holland, which is part of CNH. What's new this year is over the cab there. They've installed LiDAR, light detection,
look at that.
and radar, so that as you go
Almost
into
to the 21.
field, it can sense it. It'll control speed and steering to, quote, optimize flow and make the operator's job easier.
Makes me almost want to swing a call.
So less fatigue. We're actually seeing some fuel savings, as well as the ability to run longer days.
Now, the LiDAR is an aftermarket add-on, which is a good thing. You don't have to buy a whole new system. We're talking over $600,000 here. That's much cheaper, and that's a good idea because if you look at it, commodity prices are down, tractor sales are down, and farm incomes are going to be down for the second year in a row.
We got a V going right there.
You don't even have to pay for that one. Yeah, Ryan Jacobson is a fourth-generation almond grower up the road, but he's coming off a tough year. He's not in a buying mood yet.
I'm bullish that maybe in the next probably 18 months, we're going to see us, hopefully going through the bottom of the cycle already and maybe slowly starting to climb out of that.
So, in this environment, manufacturers have to get creative. At Deere and Gus, where they've got the first electric autonomous weeder and this autonomous sprayer, those are six figures, but maybe a farmer can just pay by the acre?
There's these interesting business models that we're entertaining around spraying as a service.
So Deere reports on Thursday, CNH tomorrow, and guys, it's all about their outlook. We'll have to watch. Back to you.
So tell me a little more about spraying as a service. In other words, you would come in and instead of buying your own equipment to do it yourself, you would hire a vendor to do it.
Exactly.
Exactly. That's sort of something that, at least
That's
in
what she
Deere's
said.
case, they're trying to think of these other ideas in this environment. Because again, you buy it, this is a huge investment, and you hold on to it for a long time. When they already have software as a service on many of these items, maybe they can just start sort of leasing out the equipment too. That
The
sort
hell
of
is
way,
it?
or bringing in the sprayers, as you say. Maybe that's a more affordable, enticing way to get sales. In this, until farm incomes start to turn around and crop prices start to go back up.
Well, it looks like a beautiful day in Tulare, California. We've got plenty of snow. Jane, thanks very much. As always, great to see you. All right, let's take you through the markets right now and do a quick market check on a day where the Dow Industrials are having their worst day in percent decline and, well, now 750 point decline since last March. That caught me by surprise, but it is, I am assured, an accurate representation. We've got the NASDAQ down 363. There you see the intraday on the Dow Industrials. NASDAQ down
SPX
more than 2%.
49.35.
About the same, a little less than 2%. Let's take a look at the 10-year yield as it climbs up close once again to well, it now is above 4.3%. It was settling most of the morning there at the high sort of 4.28, 4.29 level as interest rates rise in the anticipation that the Fed will be less quick and maybe less frequent in their interest rate cutting regime and maybe won't start until later in the year.
Right, and when you're looking at sectors, real estate really under pressure, which makes sense. Interest rate sensitive, down more than 3% just here on the session. Healthcare is performing the best, but it also is down more than 1% here on the session. And then, right sort of in the middle is financials, again, also very interest rate sensitive, down
3
about
more minutes.
6%.
Yeah, those home builders that we just showed there, all with 2, 3, 4% declines in price today. Scott Wapner will be along in just a moment to carry you through to the close here in this where the winners and losers get separated. The final hour is coming up. Thanks for watching Power Lunch.
Closing bell does start right after this quick break.
Come on, give me a candle, red one. Excuse me. Dishes to do. Get ready. One more minute and we go into power hour. And I'm looking at the 49.35 here at 190. 185. And we got a double bottom snake breakout. Excuse me. Got something in my throat there. Get a drink. 180. So I'm going to try to get. Could get it at 2. Damn it. I didn't get it. Might.
Hi, welcome to Closing Bell. I'm Scott Walker,
That's
live
funny.
from CNBC Global Headquarters today. This make or break hour begins with the bull case for stocks. How big of a blow has it suffered today with that hotter than expected inflation report? We'll ask our experts over this final stretch, including Double Line's Jeffrey Gundlach. He joins us for a Closing Bell exclusive interview in just a moment. It's a big deal. Can't wait to talk to him today. We'll also get reaction from one of this country's top-ranked financial advisors, Hightower's Rich Saperstein. In the meantime, your scorecard with 60 minutes to go in regulation looks like that. It's been ugly, and it's been ugly all day long after the release of that CPI report. The Dow is down more than 700 points, 721. We'll see what it does over the final stretch. The Russell 2000, absolutely hammered today. Small caps are super sensitive to major moves in interest rates. They are paying a price today because yields are jumping to the highest levels since December.
150.
NASDAQ, as you might imagine, not much better. Most mega cap stocks are
Double
lower.
bottom,
I want
higher
you to take a
low.
look at an intraday chart of NVIDIA as well. Okay, it's red now. It doesn't tell the whole story because it was red, then it was green, now it's turned negative by less than 1%. Interesting day for that poster stock of this momentum market. It all leads to our talk of the tape. What does today's CPI surprise mean for the rally going forward? Let's ask Liz Young, SoFi's head of investment strategy, joining us
Means
today.
we
live from
don't
the New York Stock
care.
Exchange. Liz, nice to see you.
Nice to see you too.
How much of a blow have the bulls suffered today?
I mean, it's a tough day, and we have to pay attention to that, right? One of the things that we always talk about is you can't fight the tape. The tape is always telling the truth about what sentiment is, but we're coming off such a strong rally and such strong sentiment that it's still yet to be seen whether or not dip buyers will come in here. I mean, 700 points on the Dow is certainly a big drawdown. I think the message that it's sending is that if you were investing and buying stocks based on rate cuts coming soon and coming in a big way, you have to rethink that thesis as we continue to push rate cuts out further and further. Now, that doesn't necessarily mean that the market has to have a 20% drawdown, right? I mean, the longer we wait between hikes and the first cut, the market actually tends to do okay. But certainly today, we need to reprice some of the expectation that the Fed was going to come in and support valuations at this level very soon.
Well, the fear is the great risk that was out there that they're not going to be able to cut anytime soon. And in a worst case scenario, they may actually have to hike again. Now, that's not on the table today, but it makes the PPI later this week even more important. It makes the PCE in a couple of weeks mission critical.
Right. Well, and I would actually argue it is on the table today. It's not necessarily priced into the expectations for rate moves, but the idea and the moves that we've seen in yields today, so the 2 and the 10-year, these 15 basis point moves. Now, we've seen bigger intraday moves before, but these moves are telling me that the market is actually putting back on the table the risk of overheating and the risk that the Fed not only can't exit the hiking scenario, but might have to stay more hawkish as the year goes on. One of the things that I think is really important for people to look at and track as we go forward is what the Fed calls the super core, the CPI super core. That's been stuck at about 4% for the last 7 months. Pre-pandemic, that was about 2 or 3%. So 4% is uncomfortably high. A big portion of that is transportation services,
There
which
we go
is
again.
9.5%. Now, we thought that we knew what all the big problems were in inflation. It was used cars for a while. It was housing for a while. Now we take that out, and it's, again, this whack-a-mole scenario where you've got transportation services, which is actually driven a lot by motor vehicle insurance. That is a new problem, and keeping the services component sticky. Services is always more sticky than goods, so we are certainly not out of the woods here.
But there are some who make the argument that a strong economy at this point in the cycle is more important than rate cuts anyway. That's what you should hang your hat on. I mean, that's what Professor Jeremy Siegel of the Wharton School told me just the other day. I want you to listen to what he said, as he remains bullish and not reliant on rate cuts.
At this particular point, I don't see the need for the Fed to lower. I mean, take a look at all the real indicators. They haven't slowed down. Even the advanced indicators have not slowed down. When they begin to slow down, and if inflation's under control, which I do think it is, we're going to have those lowering of rates. But I'm not saying that this bull market at all depends on the rates being lowered in March or really even in May.
You agree or disagree with the professor?
So I agree that a strong economy is obviously a bullish thing for stocks. The issue here is that a strong economy also keeps inflation higher, and it prevents inflation and disinflation from broadening out into all the areas that we need to see disinflation. So what it's doing is it's lengthening and elongating this waiting period of when we're going to see the Fed actually be able to come off of their hiking path. And I think that the Fed is going to have a lot more ability to wait than the market is. And a lot of this market move has been predicated on the idea that CPI has come down. I think a lot of people expected it to keep moving in a linear fashion, and that was proven incorrect today, or at least that now it's sort of plateaued at a level that's still uncomfortable. So I think the market is going to have to get to a place where it makes more sense to be trading at certain valuations in the face of a strong economy, yes, but also in the face of inflation that stays higher than we want it to be.
We were ripe for a pullback anyway, though, right? I mean, let's be honest, right?
Yeah.
The way that stocks have gone up since November 1st, especially the mega caps, I mean, it's been kind of crazy. I mean, just year to date, for example, I know we mention NVIDIA every day, but for good reason. The stock's up almost 50% year to date. And even for much of today, in such great upset for the market, NVIDIA stays green.
Yeah.
For much of the day. This market just needed something to give it the excuse to sell off.
Yeah, and I mean, we were definitely ripe for something, right? And that's why I say it's one day does not make a trend. So we were looking down the barrel of these huge gains, some triple-digit gains in names that it just didn't make sense for them to have moved that fast. What I think the big question that we need to find out the answer to is, will dip buyers come in more broadly than just in NVIDIA? Will they come in and buy a dip in the indexes? And that's what's going to tell us whether or not some of this inflation data actually did shift sentiment. Will money come out of the equity market? I don't know that that's the case yet, and obviously we need a lot more days to show us what investors are really feeling about it.
I mean, I'm doing a double take as I look at the Russell 2000. It's obviously been the benefactor of the narrative. And today, oh my gosh, it's down some 4%. Speaking of the narrative, I want to hear from Jeffrey Gundlach, Double Line, of course, who joins us exclusively now on Closing Bell from the ETF Exchange Conference in Miami with our very own Bob Pisani. And Bob, what a day to have Jeffrey Gundlach with us today. Take it away.
Jeffrey.
And Scotty, it is a big day, of course. Jeff joins us here speaking, of course, at the
Who's
ETF
Jeffrey?
Exchange Conference. Jeff, you just addressed 1,000 people in the audience. Your basic message today, interest rates have bottomed. I want to talk about CPI, but get to that message right now. Interest rates have bottomed. What's the implications for that for investors?
Well, interest rates have very long cycles historically. For whatever reason, they tend to move in a broad trend for about 40 years. And we all know that interest rates kind of rolled over at very high levels a little over 40 years ago. And now interest rates are up over the last couple of years. So it's almost exactly 40 years. And I just think that interest rates were absurdly low, particularly real interest rates. And now real interest rates are reasonable. But I think that we have a problem with the amount of money we need to borrow.
That'd be good news.
And that will cause a strange movement that we're all used to thinking that the economy gets soft and interest rates are taken way down by the Fed, and long-term interest rates also go down by a couple hundred basis points at least. But I got a feeling that when the economy weakens enough so that the Fed really does cut in earnest, I think we're going to be having a real big problem with people understanding how much debt expense we have, and they might start thinking that longer-term interest rates need to be at, well, they were 10% real yields in 1984. So it's not at all implausible that interest rates could go up into the high single digits, and it's part of this long-term trend. Now, one thing, I think that the economy is more vulnerable under a rising interest rate regime than it is under a falling interest rate regime. Under a falling interest rate regime, companies that are in trouble and maybe marginal credits, they, even though they might have to pay more on a spread basis, they're paying lower interest rates. So they can refinance and take money out and reduce their interest expense. That prevents defaults. That supports all of the risk assets. They're reliant upon financing of marginal companies.
Dashing
but when
through
interest rates
the
are rising,
snow.
maybe they'll have to default.
One
So
horse
maybe it
open
adds volatility to the economic cycle. And certainly that was the case when interest rates were rising in the 70s and 80s. There was tremendous economic volatility.
VZIO YouTubers.
And higher interest rates as a theme create more vulnerable markets.
Scott was mentioning it's a big day to have you on. January CPI was hotter than expected on almost every level. How does this play into the expectation for interest rate cuts? The market was expecting 6. Where are you at, and how does this data today change those expectations?
I think the market has had tremendously overpriced the amount of cuts this year. It was down to almost a certainty of 6.
Well, hell yeah, it did.
It seemed that the Fed, since they weren't going to move in March, per the words of the chairman, that means they're getting started in May. And then there's this thing called the election that I don't know, they probably aren't primarily focused on that, but to have 6 rate cuts between May and the end of the year, it always seemed like a lot to me, absent some very substantial improvement in inflationary data, which did not happen today.
Does the Fed care about elections? I mean, Jay Powell, if he was sitting here, would say, we don't make decisions based upon elections. Is that real, or is the Fed actually influenced by elections?
I think they don't want to be blamed for anything. So weirdly, it doesn't matter if they intend to be political, even if on a secondary variable, which is where I would place it. They just
Who is this
care
guy?
about the optics of things.
Jeffrey?
They prefer, all things being equal, to be a little bit less aggressive, I think, in an economy like this. Now, the CPI today, it's funny how the inflation discussion has changed over the past year and a half or so. We went from it was going to be this super core PCE was going to be the inflation metric, and that was rolled out of Jackson Hole, I think it was in 2022. And they don't talk about that at all anymore. But instead, back in November, when it seemed like they had a radical change in tone on November 1st, it seemed like all of a sudden we were talking about picking and choosing different inflation indicators and not focusing exclusively on year over year, but doing things like 6-month annualized, 3-month annualized. And today's report came back to bite them on this, because the 3-month annualized core CPI is going up now.
It's 4%.
It's 4%. The 12-month number is 3.9. So it's no longer, well, we can look at the 3-month annualized and take comfort, because that's what's really the trend is, and maybe it'll stick. because it's not sticking anymore. It's going up. So what really matters, though, is not the CPI, although it's important. It's the PCE. That comes out on the 29th. And we have PPI coming out, I think on Friday, if I'm right. And that will give us a pretty good idea of what PCE is. If PCE cannot go up and have the Fed talking about cutting interest rates.
And we've all been trying to figure out what's the leading indicator to look for here. And you had a fascinating discussion here at this conference about the 2-year Treasury as the leading indicator. We tend to think the Fed leads the 2-year and moves things around. And your position was, it's actually not true. It's the 2-year that leads the Fed around. So what is the 2-year?
The 2-year is
telling us right now.
The 2-year is sort of telling you that you're going to get about 100 basis points of cuts on average over that 2-year period. So it means that you're going to see that the Fed should cut interest rates. If they're going to do it this year, it should probably be about 50 basis points.
Let me ask about the stock market. 20 times forward earnings on the S&P. Are you concerned about the valuations? Yeah. There's a whole discussion here about the Magnificent Seven. The investment advisors are very worried about concentration risk. They're worried their clients are telling them, buy NVIDIA, and it's too risky to have too much concentration. Are you worried about that concentration? Does it bother you that it's such an important part of the S&P 500 now?
It does. I think these concentrated technology, this is going to be the future and it's going to take over the world type of talk has happened repeatedly. And the forward earnings thing kind of bothers me. They're looking for 11 or 12% earnings growth. Last year they were looking for 11%. It came out at 1%. So with the Fed rate cuts being pared back in terms of expectations, thanks to the CPI data, and the earnings being suspect, what's predicted in my opinion, I have a hard time. I have a hard time with basic passive market-weighted investment. I really prefer equal-weighted at this point. In fact, we just launched an ETF that does equal-weighted. We didn't do that on a lark. We did it because we thought that was a superior mousetrap for this moment in time.
And you have 6 or 7 ETFs you talked about here. Yeah. I want to bring in Scott Wapner, my colleague. He's got a couple questions. Scott.
Hey, Jeffrey, I appreciate you so very much being with us today, especially given what's happening in the markets. Do you think that the Fed's own calculus changes as a result of one CPI report?
No, I don't. It's disappointing to them, I'm sure, because there was tremendous hope that this gentle decline was going to continue.
Yes.
But this one cannot. The shelter numbers look weird. The OER number looks weird. It's 6% year over year. And for all I can see, rents aren't growing at that level. Home prices aren't growing at that level. And the indices like apartment rent and the Zillow indices, they lead the OER very, very convincingly by about a year to 18 months. And they've fallen tremendously, those indices. So this shelter number is really an outlier relative to kind of the trend and what we expect from these relationships. So certainly not one number with this odd type of shelter reading is going to make that big of a difference. But the PCE number is going to be super important. And then I think then the next month numbers, people will be sort of on pins and needles. But the market has priced out pretty much a May rate hike at this point. So now the idea that you're going to get, more than 2 or 3 rate hikes as a base case is kind of hard to pencil out.
They haven't fully priced it out, of course. I mean, the probabilities of May have come down. Do you think May is the starting gate?
Doesn't look like it to me. It could be. I mean, there's enough data coming out between now and then, but it's probably going to be June if it happens at all. But our inflation model is such that absent a spike in oil, which has had every reason to spike, right? Every excuse with Ukraine and the Red Sea and all that, and it hasn't. But if it stays where it is, then we think inflation on the CPI will relax, and this will be something of a blip, particularly on the headline number, and it'll go down to about 2.5%. One thing that I'm using as a leading indicator, and I have been, are commodity prices. Broadly, the Bloomberg Commodity Price Index has been below its 200-day moving average for a long time now, and it can't seem to get above it, and it just keeps falling. And that's further corroboration of relaxing inflation, but also of weak global growth and weak global demand for these commodities.
You know, there's another pretty big debate, I think, in the market. Liz Young alluded to it in the lead up to welcoming you onto the program. It's whether the economy can remain this strong and have inflation go down towards 2% at the same time, or if one causes too much demand that keeps inflation elevated. How would you address that? Because it appears as though the initial calculus of that by the Fed itself
puts
has
baby,
changed,
yeah.
in that you can still have a strong economy with solid growth and still have inflation come down because it was caused by things around the pandemic more so than excess demand.
Well, you know, I suppose that's possible. I am skeptical of, see, the last man standing in the economy is always the last man standing, and it's the unemployment rate and some of the employment data. And I know that the last report was very strong. There's some weird seasonals, but that doesn't account for the strength. And I just think that there's other employment data that leads much more than the U3 employment rate, which is really a coincident indicator. And that's things like hours, the work week, which is collapsing. It's sort of like temporary jobs, which are shrinking. A lot of these leading indicators don't share that type of strength. And I talked about this last time I was on with you, Scott. 88% of states, and the states report employment data as well, 88% of the states say unemployment is rising over the last 6 months. And those states that don't have rising unemployment include Wyoming, there's about 5 or 6 of them, Wyoming, North Dakota. Okay, they might be adding jobs, but that's not a very big population base to carry the other 88%. And the states that have rising unemployment include California, Florida, Illinois, New York, New Jersey. I think you can see what I'm driving at here. It seems very weird mathematically, just arithmetically, that these two unemployment source sets could have such disparate readings and implications. So I don't know. I hear this type of talk. Now it's soft landing. That used to be, years ago we called it Goldilocks. In 1999 they called it Nirvana. And whenever I go anywhere now, people are asking about this Nirvana situation. And that puts my radar up because that becomes sort of a, you know, everyone sort of agrees on something that maybe they need to think through a little more carefully. You know, at this conference, Bob pointed out when we were on stage that there are these types of conferences historically would always have sections on international investing, international equities, and weirdly, this one doesn't have a single one. To my eye, that says something is happening in the zeitgeist that needs to be faded, that you need to think, maybe I don't just want to nod in the north-south direction just because everybody else is doing it. So that's kind of where I am. I think this is a tell that international investing needs a closer look. And as you know, Scott, I've always recommended India, and I'm more bullish than ever. They're the strongest economy in the world with the best demographics. So that's a pretty good 1-2 punch.
I was surprised at your comment on your recommendation on allocation, because the investment advisors here want to know what are you recommending right now. I was surprised how conservative you are. 40% bonds, 25% cash, 10% real assets. I guess the rest stocks. That's a pretty conservative portfolio.
I think, if you ask me, you know, I'll give you slightly different answers on the hour of the day that you ask me these things because the markets move. But I could see having 30% in stocks, frankly. And I would have 10 in Japan, 10 in India, and 10 in an equal weighted U.S.
10 in an equal weight U.S., not a market cap.
Not market cap. I don't want market cap.
You, I mean, literally 10% of the asset allocation is just in the U.S. on an equal weighting. That's it. Because the U.S. is too overvalued. Why so?
Well, I want. Normally, I might say 35% U.S., but I got 25 of it in cash because I want to buy stuff cheaper, and I think you're going to get cheaper at some point along the line of 2024. So I want to be ready for that.
All right. Jeff Gunlock, always a pleasure chatting with you. We didn't even get into a long discussion on deficits and Social Security. He has ideas on solving Social Security too, Scott. We got to get him back and get his ideas on how to solve that next big problem.
Yeah, we will.
Jeff, thanks very much. Always a pleasure.
Thanks, Bob. Thanks, Judge. Talk to you, what is it? We got March coming up.
Yeah, we certainly do. We have another meeting coming up, which means we have another conversation in the wings too. Jeffrey, thank you. Bob, of course, thanks to you as well. Bob Pisani down at the ETF conference down in Miami. SoFi's Liz Young back with us. Also joining us now, Samir Samana from Wells Fargo Investment Institute. Samir, thanks for being here too. I hope you had a chance to hear Jeffrey. I'd like your reaction to what you heard. I can't hear him. Liz Young, you want to react to Jeffrey Gundlach?
Well, yeah, sure. I'll start at the end with the 10% in U.S. equities. I think one of the things that we haven't quite covered yet, too, is the movement in the dollar. If you look at what happened in the dollar from October through the end of the year as we were pricing Fed cuts in, this huge weakening in the dollar, which is usually a tailwind for international, particularly emerging markets. And there are some indications that maybe even places of China are bottoming. So I do think that it's worth a look. That's a difficult argument to make to investors today because they look at the charts and say, well, international hasn't outperformed the U.S. in 15 years, so why would I do it now? And there is no such thing as something being due to outperform. But if we do get cuts in 2024, and I think we will, I actually think we'll get some cuts that are more than 25 basis points the longer they wait. You will see that weakening in the dollar again, and it should act as a tailwind for international investing. So I thought that was interesting for him to bring up as well.
What about the idea of what Jeffrey said about rate cuts? This doesn't necessarily change the narrative at all for the Fed. He said it could be, in his words, just a blip based on some other factors. Is that how we should view this more broadly?
Yeah, I don't think it changes the narrative because the Fed has been pretty clear that they're going to wait until they're comfortable that inflation is moving on a sustainable path towards 2%. This is another indication that they're not comfortable with it yet. So I don't know that they even really need to change that tune. I do think that a March cut was going to be premature. Now it looks like a May cut would also be premature. So depending on how the rest of the data comes in, that's going to be important. Jeffrey's right that PCE is their preferred metric, so that is the one to watch. And unfortunately, we have to wait a couple weeks to find out what happens with it, but that is the one to watch. But I think that this is actually consistent with what Jerome Powell has said, that we're not confident yet. And this reading is going to show them that this is why they're not confident yet. Doesn't mean that it's wrong, doesn't mean that it's broken, doesn't mean that something is going terribly awry, but they were right to say that they're not confident yet that the path is in place.
Yeah. I mean, you're likely now to get some bleed through to the PCE as a result of what happened today. Our senior economics correspondent, Steve Leisman, is with us now. So you heard Jeffrey. Steve, I almost feel like, okay, so if the train is still heading towards a destination for the Fed, maybe today, and we'll see what happens later this month, adds an extra stop, so to speak, before it gets to the destination that we're all looking for.
Yeah, but the thing is that the market saw this thing as a train track, and the Fed saw it more perhaps as a cross-country path in terms of ups and downs and outs and around. There's an interesting question that was asked to Jeff, which was, does this change the Fed's outlook? And I think the answer is no. What I think it changes is the market's outlook for the Fed. And Jeff talked about one explanation, which you call the blip explanation, or maybe that's the best case scenario. The blip is that you had a lot of one-off things in January. You had that rent thing that's going to eventually come around and help us out. But there's another scenario, which is that you got at this, Scott, this notion that growth may be too strong to achieve that last mile of going from 3% to 2%. And that would require the Fed to remain higher for longer to wring that last 1 percentage point of inflation out of the system, especially the services part of the system.
Steve, you know so much better than me in terms of when the Fed gets access to certain pieces of information. Certainly they gather, data points all along the way. They're talking to people within the system, so to speak, all along. You think they're surprised by the read today? Was Jay Powell, you think, shocked by what was delivered today?
No, I think he put his feet up on the table, went like this, and said, "I told you so," right? I mean, we went back, Scott, me and my producer, Betsy Spring, and looked at the number of Fed officials who used the word bumpy last week in regards to the course of inflation. And I think it was like, 3 or 4, but that was just last week. Before that, almost every single Fed official has warned us of this, Scott. It's why, as soon as the December euphoria took over, I personally tried to push back against it because of the idea that inflation is not going to move in this straight line. Do you have a lot of economists that are saying, hey, don't give up the ghost on this. The trend of inflation is still downward. But what you need to do today, Scott, is to build in some small probability that perhaps the soft landing may need to turn into a harder landing. It's not the odds-on bet, but I was in May, and now I got to rethink maybe that May cut is not a sure thing. Maybe it's more of a June thing to think about.
You used the word just now, euphoria, Steve. You could use that. Other people have used exuberance. To what degree do you think Chair Powell has been unnerved by what he's been watching in the stock market? Things like NVIDIA going up almost every day. ARM Holdings, for example, up 30, 40% in a single day. Just the magnitude of the move that we've seen overall.
Yeah, so the other metaphor for what Jay Powell has, I think, tried to do, it's interesting as to whether he was too dovish at that December meeting, but I think he's been trying to hold back the reins on financial conditions, leaning him back against this racehorse that's been trying to run, which is the market and to some extent also the economy. I think that what he wants to have happen is he'd like to have financial conditions be a little tougher. I think maybe he's getting a bit of that today. And so he's probably not unhappy about that. To see inflation come down, he'd love to be cutting interest rates. To the question about politics, I would say he's not going to be deterred by it. He would love to have the flexibility to dance around it in the sense of getting some cuts in maybe a little bit earlier, maybe going a little bit later, so the cuts don't happen around the election if he can help it. But I think what he really wants to have happen here is to see financial conditions remain a little bit tighter, and so that they can have this last bit of inflation come out of the system. But now it looks like it's going to take a little more time, Scott.
He may not get his wish, though, in terms of in the political prism. I mean, the longer they wait, as you allude to, the closer potentially they get to the election.
Yeah.
Not only that, but the closer you get to the election, you may have to do bigger rate cuts, and that'll have its own political consequences, at least in terms of, you know, the rhetoric that the chair and others at the Fed will have to face potentially.
Yeah, but here's the deal, Scott. You get paid to be in that position, right? The Federal Reserve, in some respects, Scott, exists to take that kind of political flack. It just comes with the territory. Would the Fed prefer not to take it? Yeah. Has Powell tried to put the Fed in a position where it takes less of that flack by spending a lot of time talking with lawmakers on the Hill from both sides? But can it be avoided? No. It's going to be the source of either the Democrats saying they're not cutting fast enough, or the Republicans saying that they're playing fast and loose. I personally believe the Fed will do the right thing at the right time, irrespective of politics.
Yeah, Steve, I appreciate it so much. Thank you, Steve Leisman, with some really important context on not only what today's CPI means, but reacting to what Jeffrey Gundlach had to say, too. I think we figured out Samir Samada's audio. Can you hear me?
Yes, Scott, I can hear you.
Great. So just give me your view here as we watch the Dow down better than 700 for much of the day. Jeffrey Gundlach talking a few moments ago about what all of this means for the Fed and where interest rates may go from here.
Yeah, I mean, look, I think the real opportunity is in areas like industrials, materials, energy, and healthcare. Those are all areas that still have quite a bit of pricing power. They trade at much cheaper valuations, so the rate, elevation doesn't harm them as much from a multiple standpoint. And I think that's really where the opportunity lies. They've been left behind by this, go-go market, which is focused on, growth and tech. But I think there's a lot of opportunities for those areas to catch up, especially if the economy remains resilient and we don't get those rate cuts.
Have we crossed the Rubicon, you think, Samir, into some euphoric period? Too much exuberance that's on the verge of becoming irrational when you look at some of the moves in growth stocks, or not?
We think so. And again,
Uncle Jimmy was the first one to use the word exuberance, besides Alan Greenspan. Now everybody's saying it. Everybody's saying it. Because I was right.
Some real broadening to believe in, and we posed that question at the top of several programs this week as to whether this was broadening in the market that you could actually believe in for the first time in a while, that was going to last a little more than a couple of days. How would you address that now?
I would say you have to watch small caps and small caps only in order to confirm whether or not the broadening is occurring, and they have not confirmed that.
Well,
They got close.
I'm watching them today. I mean,
right.
that's why I bring it up. Yesterday, okay, the Russell.
Hey, be easy on her
and here
now.
we are down near 5% on the Russell 2000. It was nicely over 2,000.
Let's back off a little
Now
bit,
it's
buddy.
1950.
Right. And if you take a long-term chart of the
Somebody'll
Russell
have to hurt
2000,
you.
you'll see that there's this line of resistance that it can't quite get over. We got over it for a sniff of a second and then fell right back down.
What is it, honey?
Small caps need to confirm an upward move because that is what would show us that the economy can still expand. Also remember, and this goes to one of Jeffrey's points, small caps employ 50 to 60%
You don't cut the carrots the way I tell you to. They will not cook right.
For market confirmation, but we need small caps for employment strength. We need small caps for economic activity. And the fact that small caps can't quite get off the mat to the place that we need them to be is still concerning to me. There have been parts of the market that broadened out. Industrials is one of those that is sort of confirming the broadening, but we're back to what I would still consider late cycle behavior, which is large caps leading, some excessive risk taking in certain names in certain pockets of the market, and we still have an inflation problem and the chance of overheating. This is all very characteristic of late cycle, not
nice
mid
little
or early
bounce.
cycle.
Is that how you see it, Samir, or differently?
We do see that, but
SPX.
I will say, I think if you can pick your spots in small caps, especially closer to 1800,
49.35 is now at 210.
In the portfolio.
All right, we're going to leave it there. Samir, I appreciate it very much. Thanks for your patience today as we tried to work on your audio there, but I'm glad we were able to hear from you. Again, Dow's down just shy, well, right at 700 points. We are getting some news as well on Walmart and TV maker Vizio.
Walmart?
It is impacting, apparently, Julia, shares of Roku, right?
Yes, we see Roku shares moving lower on this headline from the Wall Street Journal that Walmart is in talks to buy smart TV maker Vizio. And we've reached out to Walmart and also to Vizio for comment. But the stock we just want to point out here is Roku. Shares are down about 10% right now. Of course, Roku, of course, has its technology not only in the devices, but also integrated into TVs. And we see Roku shares trading lower. But Vizio shares were halted briefly. They resumed trading and up by about 35%. Now we see they're up about 25%. So we'll come back to you if we have more comment on this, but certainly a lot of interest in this connected TV, smart TV space and what it means for the future of streaming.
Yeah, Julia, thanks so much for that. We'll keep our eyes there. Any day,
Oh wait, one more thing, Scott. We do have this. We do have the CEO of Roku coming up. That's going to be an interview coming up on Thursday after that company reports earnings.
All right, great timing there with Anthony Wood. Thanks for letting us know that, Julia Borston. Anything more? Please come back on and tell us. That's Julia Borston for us there. All right, let's send it over to Christina Partsinevelos now for a look at the biggest names moving into this ugly close. It looks like we're going to have, Christina.
Yeah, and I'm going to start with a name getting hurt, Shopify. The e-commerce giant are seeing shares down, what, I saw it was 12%, probably worse now, on pace for its worst day since February last year. Despite posting an earnings beat, investors had high hopes. They pushed this stock up about 10%.
Getting ready to get to hit resistance here.
But the outlook for free
on the
cash flow and
SPX.
earnings came in light, and rising costs are a concern. That's why shares are down 13%. Meanwhile, shares of JetBlue, let's see if that's maintaining. Yes, the 20% uptick today after famed activist investor Carl Icahn reported a roughly 10% stake in the air carrier. In a regulatory filing today, Icahn wrote that JetBlue was undervalued and represented an attractive investment opportunity. And that's his voice of concern, I should say confidence, helping shares of JetBlue.
Big day there. All right, Christina, thank you. Christina Partsinevelos. We're off the lows. Dow seeing its biggest drop in nearly a year. It's still around 700, 665 or so. All of it coming after that hotter than expected CPI print. With me now, Rich Saperstein of Treasury Partners. He's one of this country's highest rated financial advisors. Your phone's ringing off the hook today, I bet.
Not really, but it does. We have outbound calls we're pretty active on.
Yeah. So what's your read here? What does this mean for the rally?
Look, stocks are selling at 20, 21 times earnings, and in the last 25 years, it's only occurred 2 other times during post-COVID and .com. So right now, the market is priced for a tapestry of perfection, meaning declining inflation, accommodative Fed actually making cuts, low unemployment, and continued
Tapestry
fiscal
of
stimulus,
perfection.
as well as achieving 245 in S&P earnings this year. So there's a lot of good things that have to happen to keep the market where it is. You get a day like today where you have one data point that disappoints and you have a market sell-off.
Yeah, but you're ripe for a sell-off. Why do you need so many good things to keep things going? I would actually argue it's exactly the opposite.
Well, any one of those can go wrong, and the market's going to take it as an unhospitable act. So the market will sell off.
I know, but we've been up a ton. So yes, it's going to sell off, but does it change how the bulls should think about what this rally has done and what it might do from here?
No, I think that we have to look at the market over longer periods of time. So the S&P over the last 2 years is only up 5.5%. The mags are up 17, and the non-mags up 2.5%. If you extend your outlook over 10 years, the earnings are up 100%. The stocks are up 125%. So if you have a long-term view and you get a pullback, that's the time to add names that are attractive to you.
So what are you currently doing?
Well, we like the large technology names. If you take, let's say, Google and Microsoft and look at their cash flow in 2019, they generated $55 billion in operating cash flow. Last year, it was $104 billion. So their cash flow has increased by 90% over the last 4 years. Now, Microsoft's up 150%, and Google's is up, 115%. So the multiple of the cash flows have gone up a little bit more than we'd like, but at some point those stocks will come back, and it's important to follow the cash flows. The cash flows are growing tremendously year in, year out in these higher technology names.
Wait, so you don't think that the mega caps are overextended? I mean, you're an Apple, you're an Alphabet, you're an Microsoft, and you're an Amazon.
They're overextended relative to the cash flows. I don't want to make an argument that they're cheap, but if we look at the price to growth ratio, meaning these stocks are expected to grow at 20% this year, and the PEs are 30. So it's a 1.5 times PE to growth ratio, or a PEG. If you look at the non-mags, they're selling at roughly 3 times the price to growth ratio. Their expected growth is 6, and they're selling at like 16, 18 times earnings. So relative to the non-mags, the growth and the multiple of the mags still put them in an attractive area, especially for a long-term investor that has an opportunity to add them after they've pulled back to more reasonable levels.
But should I keep riding the mega cap stocks or go broad?
Well, you're talking to somebody that's owned them starting in 2011 and has them in teens. So I'm a long-term holder of large cap tech that generates copious amounts of cash flows. Keep in mind that these companies have moved from cyclical to structural, meaning there used to be, I want this technology. Now it's a must-have technology across all industry groups. So there's less volatility in the demand for these services that they're providing. They're also buying back stock. There's an AI push that will occur over time. So there's tremendous, long-term reasons to own the large cap tech stocks that are generating cash flows.
Well, then you can't one cannot make the argument that you just made then, and in the same breath
get off
say,
his
well,
back.
The market's too narrow. You just told me all the reasons why it should be narrow, correct?
Yeah, I don't have a problem with the fact that 30% of the market is in large cap cash flow generating equities. Now, that doesn't mean we own any of the smaller cap technology stocks. If you look at the last 2 years, compare the Qs versus ARKK, you have the ARKK over the last 2 years is down 30%, but the Qs are up 25%. So when we talk about technology, you have to separate between the large cap cash flow generating names versus the smaller cap, sometimes cash bleeding names.
What's the most actionable thing on your screen? Yeah, I mean, you liked munis. What's the thing that jumps out to you, whether we're having a day like this or not?
Well, I like the fact that rates are higher because for our clients where the return of capital is more important than the return on capital, and we have a shot at buying long-term munis at 4.5 tax-free, that's a great opportunity for us because we want to own long-term munis for many of our clients, especially because in the long run, we see the economy slowing, and that will lead to lower rates, and that would drive bond prices higher. Now, on the equity side, we're still overweight oil. Granted, you know, we thought global tensions would lead to a spike in oil prices, so it's surprising it hasn't happened, but here's an industry group that represents 4.3% of the S&P, yet it's generating nearly 9% of S&P earnings. So there are names there that are attractive. And on the technology side, you mentioned the names, whether it's you know, Google, Microsoft, Apple, you know, these or Amazon. In the long run, investors who don't own these names should own them because if you got a long-term holding period, let's say 3, 5, 10 years, they're going to continuously grow their cash flows, and they represent foundations in portfolios.
I appreciate the time, Rich. Thank you. We'll see you soon. Rich Saperstein, Hightower Treasury Partners, as you see there. Let's send it over to Leslie Picker now for a look at how financials are faring amid the sell-off. Obviously, red like everything else, Leslie.
Yeah, red like everything else, especially in the regional space today, Scott. Once again, that area under fire thanks to that CPI report, bolstering the case for higher for longer and potentially delaying the first rate cut. Take a look at the SPDR Regional Banking ETF, ticker KRE. That is down 4.7% as we head into the close today. Rates are important for regionals right now for two reasons. Number one, lower rates would help margins because they would decrease funding costs, i.e. what banks pay out to depositors. And number two, there are renewed fears surrounding credit quality. That's amid fourth quarter earnings snapshots that we've seen over the last few weeks, and lower rates would relieve some of the pressure there. So leading the way to the downside today are some of the smaller banks, more exposure to commercial real estate. Think of names like Valley National, New York Community Bancorp, of course that's been in the news lately, and First Foundation. Smaller banks have more exposure to commercial real estate than their larger peers, and smaller banks have lower reserves. So if commercial real estate truly becomes more of an issue, smaller banks have higher earnings risks. That's according to KBW analyst Christopher McGrady, who told me earlier today about that discrepancy. And you can see that in the price action today with the KRE falling a little bit more than the big bank weighted KBE. Scott.
Yeah, represented, of course, through the Russell 2000 as well, made up a lot of those, by a lot of those smaller regional banks. Leslie, thank you. Good check-in on the smaller banks by Leslie Picker. Stocks continuing to sell off after that hotter than expected inflation report. Let's get straight to New York Life Investments economist and chief market strategist Lauren Goodwin for how she's playing it. Welcome. It's good to see you. What are you doing with this market today?
I think that we will look back on the last couple of months, Scott, and know for certain that this Fed pivot rally we've been enjoying was just a step towards what's increasingly becoming in the data a much clearer binary outcome for the markets. Either the impact of Fed hiking so far is going to catch up with us sooner and we'll see economic growth slow to a mild recession sooner rather than later, or we'll see some firming, overheating, and that's what the data points a little closer to today. I don't want to overstate that point, but I think the market is making that risk much more clear in price action.
So you're betting on an overheat. Now, what does that mean for your calculus of what the Fed does?
Our base case is actually that we're going to see an economic growth slowdown sooner rather than later, but that base case points to the Fed doing essentially exactly what it said it's going to do, which is wait until June to, at least June rather, to start cutting interest rates. We're looking at a price environment where price pressures are re-broadening. It's just one report. We'll have plenty between now and May and June to clarify the picture. But because we're seeing prices paid pick up in the services sector, in the manufacturing sector, and we're seeing small businesses in the NFIB report today say that they're still looking to pass on higher prices, that's painting a sticky picture for the Fed.
But if I told you we're going to get a June cut, let's just say that's the ribbon gets cut, they start cutting interest rates at the June meeting. Why shouldn't I be optimistic still about the stock market?
In a word, because we've already seen and enjoyed a lot of the valuation uptick that comes from a gradual cutting cycle from the Fed. If we know for certain that the Fed is cutting in June, then really what investors should be thinking about is the oversized cash allocation that we've seen investors take on over the last year, 18 months. How do they lock in higher rates now? Do they move into short-term municipal bonds, short duration, high yield, or other elements of credit in order to lock in what would then in that case be declining treasury values on the front end of the curve?
See, you've been talking about credit opportunities almost every time that we've been speaking, including the most recent. You just mentioned it there. You still favor credit plays relative to equities?
I think investors have to be balanced. As I mentioned, this is a binary market. We're not likely to see a clear signal from equity until, frankly, economic data turn to the downside. Even if we get upside data from here, I don't think we're seeing the equity market do anything particularly directional. So that's an environment where you have to own mega cap tech because that's where there's growth and strong earnings, free cash flow. You also might own some of the potential beneficiaries of those trends, the digital infrastructure, et cetera. But that's a relatively narrow opportunity set for adding incremental exposure at this time. When it comes to adding incremental exposure, we're looking at shaving off of equity and, yes, operationalizing it in credit where we see yield as a better risk for the return for the risk.
But you're also making the case, just like Richard Saperstein was, who was just with me, that narrow is okay. And narrow is the play. And that maybe the 23 playbook is the 2024 playbook for all the reasons that you suggested.
I think that very well could be the case. It's not clear to me that narrow is the play, but narrow is what's happening. Narrow is a late cycle economic environment where large cap and profitability and free cash flow are more likely to benefit over time. There are going to be moments in the next couple of months, I'm certain of it, where we see enthusiasm and a broadening out in market performance. But with inflation looking sticky as it is now, with the same type of risk playbook that we've seen in 2023, I think that 2024's playbook may look similar again until we see a decisive break in the economic data.
So you think that the broadening idea suffered a pretty big blow today, like a lasting blow?
I think that could very well be the case. Look, again, I don't want to overstate the inflation data today. The disinflationary process is wavy, and we've seen several months of much better than expected inflation data. We get 1 month that looks a little worse than expected. It's not the end of the world. I completely agree with what Liz was saying earlier on the program to this end. But what it does do is cause that incremental doubt that we can see the extent of cuts that the market was expecting just a few weeks ago. And that's an environment where stickier inflation, stickier rates for longer, more of the market and more investors are likely to acknowledge that that's actually a riskier environment for the economy in the medium term than if we were seeing a clear slowdown now.
Good day to have you, Lauren. Thank you so much. Lauren Goodwin, New York Life. I forgot to officially thank Liz Young, too, for being with us. Liz, thank you, too, for your conversation at the top of the show. We do have less than 10 minutes to go before the closing bell. Let's get back to Christina Partsinevelos now, for a look at the key stocks you're watching.
You got a lot of people in this show today. Let's talk about the maker of cornflakes and Fruit Loops, seeing its shares actually climb higher despite the sell-off after posting the sales that beat analyst expectations. This would be WK Kellogg, which was spun off from Kellogg last year. And even though the company did beat, they did post a drop in Q4 sales. So what's happening is customers are just pushing back on recent price hikes and they're looking for bargains instead. And that's a trend we're seeing with General Mills and Mondelez also. You can see shares up 7.5%. Shares of hotel chain Marriott falling despite beating analysts' estimates. Its full-year guidance was weaker, partially due to a higher tax rate. This is according to management. But the Marriott CFO did say on the earnings call that she expects, quote, slower but still growing leisure revenues this year. Shares are down almost 6%. Scott.
All right, Christina Partsinevelos, thank you very much.
Thank you.
All right, we'll see you soon. Utilities, well, they're getting slammed today, too. Energy, a relative outperformer. Pippa Stevens here with a breakdown of both. So, yeah, everything's red. I mean, I can understand, yields are going up, so, I could see why utilities would be going down. Talk to us.
Yeah, that's exactly right, Scott. So starting here with utilities, the group, as you noted, is very sensitive to rates. And so the CPI report signaling that the Fed may have to stay higher for longer is weighing on the sector. Utilities typically have quite a bit of debt given how capital intensive the industry is. And so when rates go up, their costs rise. Plus, higher yields on treasuries make utility dividends less attractive. AES and NextEra are the biggest underperformers now. Both have quite sizable renewables portfolios. On the flip side, AEP and NRG both in the green. Now, in this sell-off, energy stocks are a relative outperformer with a modest 1.3% decline. That comes as oil actually trades higher, although nat gas is at a more than a 3-year low. And so that is weighing on gas producers like EQT and Coterra. The refiners, though, looking a bit better with Marathon Petroleum and Phillips 66 both in the green here. Gasoline futures are up more than 10% in the last month, which does help those margins for refiners. Scott?
Pippa, I appreciate that. Thank you, Pippa Stevens. We're now in the closing bell market zone. CNBC senior markets commentator Mike Santoli is breaking down the crucial moments of the trading day. Deirdre Bosa joining us today on what Instacart, Airbnb, and Lyft's earnings might tell us about the state of the gig economy. And Kate Rooney looking ahead to Robinhood's report out in overtime today. Mike, I guess one thing we can start on is the broadening story definitely seems to have gotten a body blow today. Russell's getting absolutely creamed.
For sure, Scott, and it tells you a few things. One is that maybe it was a little bit forced, and maybe we have a lot of weekends who thought we really wanted to try to make it happen with a potential breakout in the Russell 2000. The other piece of it is, every time we've talked about the interplay between stock and bond markets, and, treasury yields are leaking higher, why isn't it really bothering the stock market? And every time I say, well, it's still within the range. We're not above 4.25 on the 10-year. The yield sensitivity is in small caps and is in breadth. Well, that's what we're seeing as well today. You have a really good rinse in this market. It's 95% downside volume in the New York Stock Exchange. That's pretty rare. It's more like 80-20 on the NASDAQ. So you definitely have a pretty comprehensive unwind here because you got the 10-year above 4.25 to 4.3. And there's a big rethink going on, obviously, about the path of inflation, everything else. But all of that boiled together in the context of a market that was kind of at a pretty high perch. And we're not even down 3% from a high. We haven't had a 3% pullback since October. So I don't know if it's one and done. It probably isn't. The volatility index up at 17 tells you people are braced for something more. But all of that seemed to touch off, together with that CPI reaction.
Well, one thing it does, it undoubtedly increases the heart rate for PPI and PCE. And we're not going to get PCE for a couple of weeks. So now we're going to be a little bit on edge.
We will, and everyone's going to try and extrapolate the relevant pieces of CPI into PCE, which is probably going to be a little bit more tame. I do think, though, that the economic growth numbers matter quite a bit here. Because to me, if you have to wait longer for the first rate cut, or if you're not going to get as many, that in itself in a vacuum isn't somehow a body blow to the overall stock market. And you can make your peace with that if the economy's holding together. If it means there's a greater chance the Fed's going to make a mistake, it's going to end up being too tight. To me, that's potentially the bigger issue if we were to get there.
Let's see what the dip buyers too, Mike. Let's see what the dip buyers do as well. Right? Sure. I mean, look, NVIDIA was an interesting story today. We highlighted it several times. I'm pulling it up here. Like, all the mega caps are red now. Let's see how long they remain red, because there's been an appetite to buy on almost any dip in this space, and that's going to be key to watch too, I think.
Yeah, for sure. And the big stuff is down, Microsoft's down like 2%. It's really not cutting into muscle at this point in terms of the rallies those stocks have had. And for the S&P in general, the 20-day, just 20-day moving average for the S&P is like 49.06. Really, really strong rallies will find support at the 20-day. We'll see if that happens if we get there, because that would really be just a blip. I'm not sure if that's going to be enough to unwind some of what's built up to this point, but we'll see.
Almost doesn't feel like there's anything else going on but this big sell-off. Deirdre Bosa, though, you have big earnings to watch in overtime. Lyft, Airbnb, Instacart. You got a lot on your plate here.
The gig companies, that's right. So let me separate them. Take Lyft and Instacart first. For them, it's about profitability. They still don't get sustainable net income. And over the last year, Uber has really widened the gap between its stock and these others by focusing on efficiency, sustainable net income. All three of these names, they're growing high-margin ad businesses to offset the more costly real-world inputs like drivers and shoppers. So investors are going to want to see some progress here. Airbnb, meanwhile, it has been profitable for a while. And for Chesky and team, it'll be more about growth and pricing power. Airbnb guidance last quarter fell short of expectations, but the stock is up nearly 30% over the last 3 months. And Scott, since everyone is looking at inflation CPI today, we may get some clues tonight from these companies. Airbnb, what's the average daily rate? Is that still rising? And Instacart basket prices for an indication of how groceries are doing.
You got Robinhood. Thank you, Deirdre. I appreciate that very much, Deirdre Bosa. Kate Rooney, to you on Robinhood. Those earnings as well.
Yeah, Scott. So for Robinhood, investors are really searching for any signs of a rebound in Robinhood's once very active retail traders. Last earnings season saw Robinhood with a drop in monthly users and revenue per user, so analysts are hoping for a turnaround there. It recently launched in the UK, so that could help user growth as well. Robinhood's been looking to woo customers from Schwab and some of the other incumbents with this bonus for people transferring money in. We'll see how that plays out. Robinhood changed the way it also charges for options, so that could help some of its operating leverage. It's among the companies that have gotten a lot more disciplined on costs. The Street is looking for a loss of a penny per share. If you look at a year ago, it was losing 19 cents per share. Rates are also key. Higher interest income has helped offset some of the trading slowdown. And finally, Scott, crypto volume is expected to come in strong as those markets rebounded in Q4.
Kate, I appreciate that. Thank you. That's our Kate Rooney. Take a look at the Dow here. We're down more than 700 points at the worst levels of this session. We've paired that a little bit. We're down 555 right now, but it's a rough day across the street. The Russell 2000 is really where the pain point is. Mike Santoli, I'll send it to you to take us into the close. You tell us what you're going to be watching here.
Yeah, for sure. And the NASDAQ 100 actually did find a little bit of a bid in there. It's down about 1.6%. Still, the biggest downside contributors to the overall S&P 500 are the biggest recent winners. That would be Microsoft, Amazon, and Apple. I pointed out the very, very weak breadth before, and it remains the case. That has not turned around. 93% of all volume in the New York Stock Exchange is in declining stocks. That is a pretty good across the board.
Well, there it is. What a day. We will catch you all later. Retail.